from the heart of where innovation, money, and power collide. In Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
I'm Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, hackers get their meat hooks into the U.S. food production chain. Literally, a ransomware attack over the weekend wipes out nearly a fifth of America's meat production. We're going to have the latest, plus what the Biden administration plans to do about it. And trading apps go public. SoFi makes its market debut via SPAC ahead of an IPO by Robinhood expected in the next few weeks. We'll talk to CEO Anthony Noto about what he thinks makes SoFi the better bet. Plus, is it even worth it? That's what some employees are asking ahead of orders to return to the office after more than a year of remote work. Some workers are quitting if companies don't offer flexible options. We'll dive in, as tech is what's making all options possible. Those stories in a moment, but first, U.S. stocks came in lower today, while Zoom's earnings are out after the bell. Zoom shares dropping swiftly after the close, Katie, but recovering now. What do you see?
Well, Emily, it was a pretty quiet day in markets overall, kind of lackluster. The S&P 500 basically flat. Tech and semiconductors also fell down about 0.4%. And if you were looking for a bright spot, you found it in energy, because that sector rose about 4%. That's after OPEC stuck to its output plans and also gave a bullish outlook overall for the oil market. And speaking of bright spots, Bloomberg News reported today that KKR and CD&R are closing in on a deal to buy cloud software firm Cloudera at a deal that would be valued at $16 a share. And as you can see, that just sent shares flying up about 24%. And it was also a good day for ADRs, because you saw JD.com, Pinduoduo, NIO all rallying today. And NIO in particular got a boost from a Citi upgrade on its accelerating orders. But Emily, we also got some earnings after the bell, so let's end there, because Hewlett-Packard falling after hours. That's after its quarterly earnings actually rose 11% on a quarter-over-quarter basis, but its profit forecast, analysts are calling that tepid. And Zoom is an interesting story because it beat on revenue and EPS, and you initially saw the shares fall, but clearly traders are now parsing through that earnings report and finding some things to like.
All right, Bloomberg's Katie Greifeld, thanks so much. Of course, Zoom, a big pandemic story. We'll see how that one plays out. Meantime, another week, another cyber attack, and this one on JBS, the largest meat supplier in the world. The attack has forced the shutdown of some of the largest meat plants across the country. Michael Chertoff, former Homeland Security Secretary, joined Bloomberg earlier today to talk about how the current administration can help mitigate the damage.
We have a pretty good idea who's doing it. The question is, how do we upstep the tempo of our defenses? And I think one of the things that the Biden administration has done with this new executive order is try to get the federal government and vendors to put a much more robust and detailed system of preparation for defense in place as quickly as possible.
Let's get some insight now from Lior Div, the co-founder and CEO of CyberReason, a cybersecurity tech company that fights would-be hackers. So, Lior, first of all, I have to talk about the target. First, it was Colonial Pipeline and oil supply across the country. Now it is the very food we eat. Do you think hackers intended for food to be the target here?
Thank you, Emily. We believe that hackers are almost blind when they choose the attack. In the JBS situation, we believe that this is yet another ransomware hack that's coming from Russia. Probably not state-sponsored, but for sure state-ignored. We believe that the Russian government can find, they can know who is basically behind those hacks. And we believe that they choose not to stop them. We believe that right now we are in a war situation against those ransomware groups that exist out there.
A war situation against a ransomware group, or would you say a war, some sort of cyber war with Russia?
Yeah, well, look, ransomware is basically right now, it's a business model. As long as hackers were gonna keep making money, and a lot of money. For example, the Colonial Pipeline situation, they collected not just from the Colonial Pipeline, in general, in less than a month, $90 million. This is a lot of money for a small group. So we believe that they're making money. As long as they're making money, it's a business model. And as long as it's a business model, they're gonna keep hacking. So right now, it's not just about companies fighting against and ending cyber attack. It's about the government against government, basically putting pressure in order to stop those groups.
Now, JBS, the company that was attacked, released a statement saying JBS USA determined that it was the target of an organized cybersecurity act. Resolution of the incident will take time, which may delay certain transactions with customers and suppliers. When you say the hackers are blind to the target, do you mean that they're just looking for weaknesses anywhere? It doesn't matter what company it is or what kind of services they offer? Or do you think they intend to pick targets that wreak havoc, like impacting U.S. food supply?
We're tracking those groups basically on a daily basis. We have a specific group inside Cyber Reason that tracks them, understand what they are doing, and how they're conducting their business. We believe that they're not choosing their target specifically. They want to maximize on the capability to make money. And they don't care if the supply of gas or meat gonna be stopped. They care about one thing, to make money. So this is the reason that we believe that they are blind and they're not choosing carefully the targets. Needless to say that usually they're going after big companies that can pay.
If Russia, as you believe, isn't stopping this, then what should the U.S. be doing to try to mitigate these attacks, to prevent these from happening? It just seems to be one after the other.
Yeah, no mistake. It's like many companies today are still using ancient technology that used to basically protect hacks from 20 years ago, like Symantec and McAfee. But right now, the industry, the cybersecurity industry, have the capability to stop this type of hack. We at Cyber Reason can do it. There is other companies that can do it. And basically, there is a new technology that called EDR, endpoint detection and response, that can end those ransomware hacks. So it's not a phenomenon that we cannot fight against, but we have to change the way that we're thinking about the problem together with the federal government.
With the federal government. All right, Lior Div, strong words there. We're going to keep following the fallout from this particular hack. Thanks so much for weighing in. Lior Div, co-founder and CEO of Cyber Reason. All right, coming up, Uber and Lyft riders are reportedly seeing a surge in prices as demand spikes. Are drivers in short supply? We're going to check in on the ride-hailing companies next with Dan Ives of Wedbush Securities. Next, this is Bloomberg. Uber and Lyft prices are getting to some jaw-dropping levels, according to a recent report by the New York Times. The report citing a lack of drivers and growing demand by users for rides. This is all part of the new normal, it seems. Let's get some reaction from Dan Ives, analyst at Wedbush Securities. You know, Dan, having taken a couple of rides in the last couple of months, I noticed the price increases, but it's not necessarily unexpected with things the economy starting to get back up and running. But is this a bigger problem, and could it be a persistent problem?
Yeah, this has really been a gut punch to demand. I mean, we see price increases at surge levels in some cities up 50, 60, 70%. Now, a lot of that's driver shortage. We could say, you know, sort of roaring 20s demand coming back. But this is exactly what Dara does not want to see at a time that there's springboard demand. Because ultimately, price increases, that continues to right now be a dark cloud over the stock.
So why is it happening? Are there not enough drivers? And if there aren't enough drivers, how do they get more drivers?
Yeah, the driver shortage is a major issue. I mean, we think right now driver shortages in some cities could be down as much as 40% relative to where they need to be. And it's a problem because the drivers need to come back. There also needs to be incentives to bring drivers back, more promotions. And this is an issue for Lyft and Uber. You know, and ultimately, some could say it's a high-class problem in terms of demand, but this is at a time that consumers are starting to come out, still have some health concerns in terms of getting into Ubers and Lyfts. Then all of a sudden they go on the app for the first time in 15 months and see prices that are double what they normally see. So this really right now, exactly at the wrong time continues to be a bit of an overhang. And what really now is starting to be a bigger problem for Uber and Lyft right at the wrong time.
There are also long wait times, and I can testify to that personally. And I wonder, how long do you think this problem will continue?
Yeah, I mean, I personally did an Uber, and I could have had a 5-course meal waiting for a driver. And I think, look, it's a problem because I think this could last throughout the summer. And right now, I think at Uber headquarters, they're trying to figure out ways to bring more and more drivers on, because then ultimately there starts to be that balancing act in terms of when you're comparing taxis or other forms of transportation. And when you talk about surge pricing and wait times, I mean, those are the two, really killers to the business model for the likes of an Uber and Lyft. So right now, that's something that they're really going to grapple with at a time that demand's starting to go back now. In the last 6 to 9 months, been a great trend. But surge pricing and wait times, continues to be almost a chronic problem right now for the likes of Uber.
Well, what about the incentives? I mean, what are you seeing that Uber and Lyft are doing to try to get more drivers on the road? And are they doing enough?
Yeah, I think they're going to need to do more. Driver incentives are key in terms of promotions, bonuses, more incentives to bring back drivers. And it almost becomes a bit of an arms race now between Uber and Lyft in terms of bringing back those drivers. And if they, if one ultimately wins, they're going to get more mind share. And this is, importantly, this is coming at a time that consumers are now just starting to come out. And we can talk about roaring 20s type demand going into the summer. But if they don't get into the cars and they don't transact, then that really becomes some false positives. And that's the problem here. They need to figure this out quick because time's not on their side. Otherwise, they lose share.
Interesting. All right. Something we'll continue to follow. Dan I is Managing Director of Equity Research at Wedbush Securities. Always good to have you here, Dan. Meantime, back to the story that Amazon has updated its terms of service regarding Alexa voice recordings. We're going to get back to Bloomberg's Matt Day, who, of course, covers Amazon out of Seattle. Matt, first of all, what is Alexa accused of doing here?
So Alexa's accused of doing something it does by design, which is just store your voice recording. What plaintiffs in a bunch of lawsuits now are alleging is that just storing those voice recordings really for any purpose without explicit consent of whoever speaking violates state wiretapping law in a few states across the country.
So what does this mean for Amazon? I mean, could there be a flood of lawsuits if there are thousands of complaints already?
Well, there already have been, functionally the equivalent of lawsuits with, 75,000 complaints for arbitration with customers seeking redress from the company. So it's definitely something that's already on their radar and has been for the last couple of years. Now they haven't told us much of anything on their expectations for liability, and we're not getting much in the way of dollar figures from the plaintiffs either. But it certainly is a hot spot in terms of the people taking Amazon to court these days.
Well, and what has Amazon said about what Alexa is doing? Is Alexa just doing her job and what she's been programmed to do?
Amazon says so, and they say, listen, we've given users plenty more options to toggle, how long Alexa stores your recordings by default. You can go in and automatically delete stuff now in a way that you couldn't just a couple of years ago. But I think that clearly hasn't bridged the full gulf from people who say, listen, Amazon doesn't need to collect this stuff anyway, and depending on how you read wiretapping law, that could be against the law.
So practically, Matt, how big a threat do you think this is to Amazon?
Well, it's clearly already compelled them to change some of the ways that Alexa does business. I guess the harder question to answer is how much does Amazon need to store all that data forever? Because the real big argument they would make is, they're fighting to create the next artificial intelligence, speaking software right up there with Google and Apple, and they think they need to hold on to these recordings to be in that race. So I think the jury's definitely out on how much they actually need this stuff, but they claim it's useful.
All right. Well, we'll expect you to keep us posted on this one. Our Bloomberg News reporter, Matt Day, who covers Amazon. Thanks, Matt. Coming up, a new COVID phenomenon companies might not have seen coming. Employees are quitting their jobs if forced to return to the office. We'll tell you why next. This is Bloomberg. With the COVID-19 pandemic receding for every vaccine that reaches an arm, the push by some employers to get people back into the office is clashing with workers who have embraced remote work as the new normal. While companies from Ford to Google and Citigroup have promised greater flexibility, many CEOs have publicly touted the importance of being in the office, driving some employees to consider quitting or actually quit. Joining us now to discuss, Bloomberg's Anders Melin, who wrote a story today about this phenomenon. So, Anders, your story opens with an anecdote about a 33-year-old mom who has 2 kids. She's enticed to the job with the promises of remote work, but the meeting invitations pile up. She has a meeting on the calendar, goes to work, decides it's not worth it, and quits. How often is this happening?
So we are not sure exactly how often it's happening, given that it's ongoing, but it is definitely on top of minds for thousands of people out there. The response to the story has been really, really great, and it has not been difficult to pick up chatter on social media. Even in my group of friends, there are many people weighing precisely these questions. You know, I've been working remotely for a year, it works, my boss knows that it works, why am I being called back into the office?
This is dinner table conversation everywhere for those that are having dinner together yet. And I wonder, what other scenarios are you seeing? Because, you know, obviously quitting is the most extreme form, but, you know, there are a lot of options, and technology is enabling a lot of options. And so how are employers debating these options?
So right now, I feel like we're in a bit of a everybody's kind of watching everybody else, gauging what to do. Obviously, the remote flexibility models are being rolled out, and companies going with hybrid options, perhaps work some days from the office, some days from home, letting workers decide. And that feels like a route that a lot of companies are taking right now, sort of to wait and see. But then you've also had certain CEOs come out and say, you know, on record that I'm tired of Zoom meetings, I'm tired of not being in the office, I want people in, and especially junior people need to come in. So it's a bit of a waiting game at the moment.
So talk to us about the people you talked to, the reasons they gave for quitting, and how employers can perhaps think about that, hear that feedback, and integrate it into their own plans.
Yeah, the person you mentioned who we had talked to, a 33-year-old mother of 2 in Georgia, she was saying that, you know, the pandemic is not over, regardless of what people say. Virus is still out there. And I don't really know how to trust that my employer, ex-employer now, is taking it seriously. And I also have no control of whether my colleagues are getting the vaccine or not. We spoke to a former Goldman Sachs partner who was saying, frankly, I was more productive from home than in the office, and you know, getting on a plane to go to London or Los Angeles just for a day for a meeting, that's just a way to ruin your life, and that's not the way to do work-life balance anymore. So she ended up leaving and is now in a fully remote position. So, you know, other people cite they want to strip out the lengthy commutes. Other people want to just have more flexibility in their days and be able to work during hours when they want to work, perhaps go for a walk in the middle of the day. And childcare, of course, is the perennial problem for parents, and that's not one that has gone away.
Do you get the sense that this is a generational thing, or that some of these people would feel differently if it was, let's say, a year from now and the pandemic is hopefully safely in the rearview mirror and children are vaccinated?
There's definitely a generational component to this. It's hard to say how great it is, but we cite a survey in the story that shows that younger workers tend to push even harder for working remotely and are even more prone to quit their jobs. And this is just playing out on a sort of anecdotal basis in terms of certain CEOs that are older that have come out pretty strongly and advocated for an in-office model. But I think it's fair to say that the generational aspect is definitely there. It's an underlying one.
So how do you expect employers to react? You mentioned that everybody is waiting for everybody else, and it certainly seems that's the case in Silicon Valley. Google has put a stake in the ground. I know people who work at Facebook are waiting to hear from Facebook about what their marching orders are going to be. And obviously it could go in a number of different directions.
It can, and I think one way that companies are using this is the ones that have made a decision and said, we're going to be remote first, we're going to be flexible for workers. They really have an opportunity now to come out ahead of the curve and actually attract employees who feel very strongly about this and who don't want to go back to work. And they might end up actually forcing the hands of these larger employers that might just be waiting to see what everybody else is doing. So I think a lot of that stuff is going to shake itself out over the summer, and especially as we go into the fall, when companies might be even more, you have to come down to a decision. Are you going to call people back into the office, or are you going to stay fully remote or with some flexibility?
Right. I get the sense that September is going to be decision time for companies and for workers. Bloomberg's Anders Melin, thank you so much for joining us. Great piece. You can definitely check that out at Bloomberg.com. All right. Coming up, fintech darling SoFi debuts on the public market via SPAC, a SPAC deal with outspoken venture capitalist Chamath Palihapitiya. SoFi CEO Anthony Noto with us next. And Lockheed Martin and GM partner up to develop an all-terrain electric moon buggy. We're going to look at when we can expect to see it on the lunar surface. This is Bloomberg. Welcome back to Bloomberg Technology. I'm Emily Chang in San Francisco. Let's get a check now on the always entertaining meme stock movements of the day and where crypto landed as well. Bloomberg's Katie Greifeld with us from New York. Katie, take it away.
Well, Emily, it was another huge day for meme stocks, largely thanks to AMC surging another 23% today. And initially it was news that AMC sold shares to Mudrick Capital that started this rally. But then Bloomberg News reported that actually Mudrick has sold its stake. But as you can see, shares went higher still, and it dragged the rest of the meme universe along with it. But really, Emily, the real action was in AMC, and that's partly because call activity has been so intense in this stock. Daily options volume continues to just hit record after record. And as we learned in January, in February, when a dealer sells a call, they have to buy a little bit of the underlying stock to then hedge their position. And when you see call activity just go straight up like we've seen on this chart, that can create a little bit of a feedback loop. And Emily, AMC's rally has been so intense that it's making Bitcoin look boring. AMC is now up 1,400% year to date. That's higher than even GameStop. And meanwhile, Bitcoin is only up about 25% on the year. And as we know, it had a rough couple of months. It's looking like it's starting to bottom here, but still has a lot of ground to make up, Emily.
Hard to make Bitcoin look boring, but AMC has done it. Katie Greifeld, thanks so much for that comparison. All right, meantime, SoFi gained in its first trading day following a merger with Social Capital head of Sophia Holdings, the SPAC led by investor Chamath Palihapitiya. SoFi offers a range of financial services from loans, mortgages, and credit cards to personal investing in all kinds of assets, including crypto. SPAC mergers have seen lackluster performance over the last couple of months, but there's hope fintech SPACs in particular could revive the blank check industry. Joining us now to discuss, SoFi CEO Anthony Noto, along with Bloomberg's Sonali Basak. Anthony, Sonali, thanks so much for joining us. So, Anthony, nice day, big pop, not too big, not too small. Curious how you're feeling at the moment about the decision to go public via SPAC when it seems like the SPAC honeymoon is kind of waning, whereas the traditional IPO window is wide open.
You know, history has shown there's a number of different ways to go public. There's three primary ways: a direct listing, now with a primary offering, a regular way IPO, and then a SPAC merger IPO. The SPAC merger IPO was the right choice for us. I was an investment banker. I led Goldman Sachs TMT banking for a number of years. I was a research analyst covering the internet and media sector from 99 through 2007. So I've seen dozens and dozens of IPOs, and every company has different facts and circumstances. And as related to SoFi, we had a couple of unique things we had to solve for. One, a large percentage of our capitalization was preferred shares instead of common, and that needed to change both to be a licensed national bank in the United States, also to be a public company. We also had to raise capital, which we were working on privately to pay off a seller's note for the acquisition of Galileo in March of 2020. And then we wanted to capitalize the company for the long term as part of our bank application process. We were raising money privately, and along the way, our business continued to really accelerate in the fall and into the holiday season. And we were very in a great position to have a lot of options. So we decided to really execute three legs of a stool. One was a private investment from T. Rowe Price at $75 million of an investment that we closed on about December 27th. We then launched a PIPE from December 28th to the 31st, and we raised a considerable amount of financing in that regard, and then announced the SPAC on or about January 4th. And in total, raised $2.4 billion, converted our preferred to common, paid off the note to Galileo, and capitalized the company for the foreseeable future, both if we get a national bank license, which is our goal, as well as funding our business into the future. So a really great outcome for our shareholders, our team, and our partners, and I couldn't be happier with where we are today.
Now, SoFi is helping to empower a new generation of retail traders, taking stocks like GameStop and AMC to high highs and low lows. Do you have any hope that retail traders might pick up on SoFi itself, or do you prefer to steer clear of the potential volatility that could involve?
Well, I would first say that we focus on giving access to investing to SoFi members, and we want them to be long-term investors. We want them to consider all of the investments that they make, ensure that they're suitable for themselves, and they take a broad-based, diversified portfolio approach and invest for the long term. When you say the word retail trader, in the back of my mind, I instantly think day trader. And we're very fortunate in that less than 1% of our brokerage accounts have more than 3 trades in a day. And so we're trying to educate our investors on using recurring investments, which is a feature and functionality we've enabled on a number of stocks for it to be automatically invested in those stocks. We also have robo accounts, which is another way to drive diversification. And we've introduced 5 SoFi ETFs, which are a low-cost way in terms of dollar per share, but against a diversified portfolio of stocks against a specific theme, like the gig economy. We have the SoFi Gig Economy ETF and others. As it relates to the retail trader mentality that's talked about on television quite often, I do think it's really important in this world in which we have a significant sector acceleration in people accessing public markets that they do in an educated way. And it's a responsibility of all the brokers to ensure that the assets that are being bought and the way they're being bought is suitable for that investor base.
On that note, Anthony, is there anything that concerns you about the current day trader rally that we're seeing in the markets, especially at these levels?
I really don't try to take a perspective on the markets. We're in the business of providing our members with products that help them get their money right. We're doing that in our Invest product, and we're doing that more broadly, whether it's reducing their cost of debt, giving them access to unique investments like IPO investing on the platform, or the SoFi branded ETFs that we created, or robo accounts that we created. That's what our responsibility is. And we do provide education as it relates to the volatility of markets and what we're seeing, but we're not taking a position on the market.
So you recently said that your clients are asking for crypto more than most other things. I would love to know the numbers. How many people are trading crypto on SoFi right now, and how much has that grown?
Yeah, first to your first point, when I first arrived in 2018, I had a view that we need to offer a broad selection of products in our SoFi Invest offering, and that there was an opportunity to differentiate by offering a broader set of products, one of which is cryptocurrency. So we offer single stocks without commissions. We pioneered fractional shares. I mentioned ETFs, robo accounts, and cryptocurrency. When we surveyed our members to see what they wanted, in the top 3 was cryptocurrency, and we do provide that. And we provide a very clear warning every time they enter an order that cryptocurrency is highly volatile, it's unproven, and you could lose all of your money. We haven't disclosed the specific percentage of our Invest members that are buying crypto, but it is one of the fast growing areas within our Invest product. And we're also seeing growth in brokerage very strongly, and fractional shares.
Now, SoFi offers an alternative to apps like Robinhood, and Robinhood also offers crypto trading services as well. And I'm curious, with Robinhood planning to go public, we believe in the next few weeks, what do you think SoFi has on Robinhood?
Well, I'd say generally we're competing against the traditional banks. There's 500 million accounts that are still attached to legacy FDIC banks that don't provide a comprehensive suite of products. We're a one-stop shop. We're offering lending products, investing products, savings and spending products, and protecting insurance products on one mobile platform. So you can do it all with us. Even within Invest, we're the only place that you can buy single stocks, fractional shares, ETFs, robo, and cryptocurrency. If you wanted to buy 3 of those 5 products at a time, and you didn't do it on SoFi, you'd have to use 2 other apps. You can do it all on SoFi. Not to mention, if you use our SoFi Money account, you can put your direct deposit into SoFi Money, you earn interest on that money. It easily transfers directly into your Invest account with you doing virtually nothing. Just when you want to buy a stock, the funds get moved over. So it's sitting in your checking account or your vaults, and it's seamless. We're trying to make our products broadly appealing, but also make them better when they're used together. SoFi Money and SoFi Invest is a perfect example of that. And increasingly, you'll see that with the other products. When we launched SoFi Credit Card, we double your rewards on your credit card when you redeem into SoFi Invest, into fractional shares or cryptocurrency.
Anthony,
we want to show the value of 1 + 1 is more than 2.
Anthony, I'm curious about credit products a little bit. Just a week ago, we saw Elizabeth Warren really drill into the bank CEOs for overdraft fees. I'm wondering if you think lawmakers have a reason to be concerned when it comes to the banking system and the fees that consumers face when they're charged among typical banks, the contender banks.
I absolutely think the lawmakers should focus on those fees. We do not charge for overdraft fees. We have free overdraft protection on our SoFi Money account. We also provide high interest on our SoFi Money account, regardless of where you put your money. We think you should get the same interest rate on all of your cash. Why should you have to put it in an X account versus Y account? The industry is using legacy frameworks and legacy approaches to modern day. Digital provides an infinite permutation of the products we can create, but somehow banks are still open from 9 to 5. Somehow trading is only 8 hours a day, Monday to Friday. Cryptocurrency is 24/7. Why isn't all trading 24/7? Why am I getting charged fees because I go a little bit over my account when I have direct deposit with you and you know the money's coming in? Why is my money not available as soon as you get access to it? We just enabled 2-day early paycheck on SoFi Money if you do direct deposit with us. Why? Because it's available 2 days early. So why shouldn't we make it available to you? We have to put our members' interest first, not our interest. If we take care of their interest, they'll take care of our interest. It's a simple axiom. It's proved to really serve companies over time. And so the lawmakers should focus on fees and ask these tough questions.
Anthony, you're in partnership with Chamath Palihapitiya, and I'm curious how valuable that partnership has been to you. You know, we know that if you look over the longer term, some of Chamath's deals are underperforming the market. How much advice is he giving you on a daily basis, and how helpful has that been?
Chamath has been a phenomenal partner, as has Social Capital. They raised a SPAC which had $805 million. We were looking to finance our company through the private markets, and along the way, we were offered opportunities to combine that with merging into a public company. Chamath's team provides us strategic opportunities that are beyond the SPAC. We have a very similar interest. His company's called Social Capital. Our company's called Social Finance. So there'll be things that we can do strategically well beyond the SPAC. That was an important element to the relationship. The second important element to the relationship is we knew they had a robust team that could do the level of diligence that's required to provide credibility to the PIPE investors to credentialize us with them as they were recommending SoFi to those PIPE investors. We had gone through that process with T. Rowe Price, which was also credentializing. Chamath and his team doing that was an additional element of credibility with those PIPE investors. And that diligence process was quite thorough and frankly more thorough than an IPO, because not only were the underwriters doing the diligence, his team and the vast network of capabilities he had and he brought to the table was part of that to make sure we're ready to be a public company. And then third, he's done 5 SPACs. He's executed 5 SPACs successfully through the de-SPACing process. I'm not talking about valuation or what the shareholder base is, but the process of giving us an opportunity to merge with a public SPAC, to have that capital on our balance sheet and do that successfully was an important element. We are a consumer brand, and ensuring that we we had deal certainty was very important. So a great partner now is going to be a great shareholder.
Good to know. I hear you. Anthony Noto, CEO of SoFi. Thanks so much for joining us, along with Bloomberg's Sonali Basak. Okay, coming up, Lockheed Martin and General Motors teaming up to create an autonomous electric moon buggy. We're going to take a look at the new rover and when we can expect to see it driving around on the lunar rock. That is next. This is Bloomberg. Space exploration is getting a big boost. President Biden's 2022 budget proposal gives over $24 billion of fresh funding to NASA, in the largest amount ever given to the space agency. The amount paving the way for more opportunities for space-related research and deep exploration. On the heels of new funding and calls from NASA to create a lunar vehicle to support the Artemis mission, Lockheed Martin and General Motors have teamed up to develop an all-electric lunar terrain vehicle. The partnership aims to create a rover that can deliver people and supplies to the moon's dangerous South Pole region. Joining me now for more, Lisa Callahan, Lockheed Martin Commercial Civil Space Vice President and General Manager. Lisa, this is absolutely fascinating. Talk to us about how this lunar rover proposal is different from the Apollo moon cars and how this all will work.
Yeah, so thank you for having me today, Emily. Really excited to be here. So the Artemis program is a program that's going to take humans back to the surface of the moon. And what's different than the Apollo days is that we're going there to stay. We want to have a sustained presence on the moon and be able to use the moon as a leaping off point to go even further into our solar system with humans, to really expand our understanding of the solar system and the science, which will really help us here back on Earth to understand what's happening on our planet. And so one of the things that, as you mentioned, is we just last week announced our partnership with General Motors to build a mobility platform for NASA and for others that want to explore on the lunar surface. And we're really excited about that partnership.
So the space race is heating up among private companies. What makes you think that Lockheed Martin has an edge to win this lunar rover NASA contract?
Yeah, so we're really excited about the partnership with General Motors because it's really taking two different industries and bringing the best of both of those industries together. This non-aerospace industry partnership is something that I think you're going to see more and more of as we move forward into the future, because if we're going to have a sustained presence on the moon or other planets like Mars, it's going to take industries beyond aerospace to make that happen. And so this partnership, and what I think is unique about it, is taking the 50-plus years that Lockheed Martin has in building exploration spacecraft that have explored every planet in our solar system, with the expertise and innovation and technologies that General Motors is investing in battery technology as well as autonomy, and bringing the best of both of those companies together to build this mobility platform, again, for NASA, for the Artemis program, as well as others in commercial industry.
Biden's funding for NASA definitely gives commercial space a boost. What should investors be most excited about?
Well, I think one thing I'm excited about is the continuity of the Artemis program moving forward. The Biden administration has been in complete support for that program, and I think that's exciting. Also, there's a slight increase in the budget for NASA, and we're seeing a complete increase in the amount of investment that's coming into the space domain in general, with investments last year in the billions of dollars that have coming into this industry. And so it's not just the U.S. government dollars, but investment dollars that are making space a really exciting time to be a part of it. And I think that's why you see all the excitement around space and what the possibilities are for the government as well as commercial economy at the moon and other places.
So let's talk a little bit more about the Artemis project, because NASA's Artemis project is planning to send astronauts back to the moon. Lockheed's Orion space capsule is an integral part of that. Give us an update on the space capsule and when we might see something like this happen.
Yeah, absolutely. So the Orion spacecraft for what they call Artemis 1 was handed over to NASA at the beginning of the year in January. And she has been going through her launch processing with the ground system right now. She's completely fueled, and we are ready to start to put the launch abort system on top of that. The launch abort system will go over top of the crew module, and it is in place as a lessons learned from previous shuttle missions and the Challenger disaster. So the launch abort system is on the spacecraft for safety reasons, to be able to take the astronauts and the entire crew module away from the rocket on the pad, as well as during the ascent phase, should there be an anomaly during that time frame. And then it would eject the crew module so that it could safely land in the ocean to keep the crew safe. So once she gets the launch abort system stacked on top of the Orion crew module, we'll then bring the Orion, the full capsule with the launch abort system to the vertical assembly building, where they will put the Orion capsule on top of the Space Launch System, which is the most powerful rocket that's ever been built. And the Space Launch System will then carry Orion out towards the moon. We're really excited about this. It looks like we're going to be launching later this year in the November-December timeframe for the first mission of the launch of the SLS system with Orion. And then that mission will be that will be about a month-long mission where we will go around the moon. The spacecraft, which is designed for deep space to go further than ever before, will go further than ever any spacecraft, human-rated spacecraft, has gone. And it's about 30 days worth of just putting her through her paces to test out all the systems that are on board, and then she'll come back to Earth safely. And then just shortly after that, we'll be ready to start to fly crew. So that's an uncrewed mission for the first Artemis mission.
Incredible. You know, we opened the show with yet another massive cyber attack, one happening after another. Our guest said that hackers don't care who the target is or how much havoc they wreak. They just want to make money. How are you thinking about space-related cyber attacks, given that the stakes in space are incredibly high?
Yeah, no, that's a really great point. I think at Lockheed Martin, we believe we have one of the best cybersecurity infrastructures in place, and that's no different for our operational systems as well. And we take cybersecurity extremely seriously, so that we can be careful and making sure that our spacecraft and the astronauts that are riding on board our spacecraft are safe.
So tell us then a little bit more about what's in Lockheed's pipeline. The next 1 to 3 years, these missions are incredibly important. What else should we be watching for?
Yeah, so we just announced a partnership with GM for the mobility piece of that. We think that mobility is a critical element to the Artemis programs, because when the astronauts arrive on the surface of the moon, and we're really excited that we're going to see the first woman and the next person of color land on the moon here in the next, in this decade. But once they get to the surface of the moon, they can only explore around their spacecraft. And one of the things that I think is interesting for viewers to know is that when you want to land something on the moon, you want it to be as flat as possible. And where people want to explore and get great science is in the area that's really rocky and a rougher terrain. And so for the astronauts to get to that area where we can get the science that we're looking for, they need a platform that can give them that mobility to get to those areas of the lunar surface. And so that's a big piece of it. The other piece I would mention is, as we're looking to stay on the surface, there's infrastructure that needs to be there. So I think you'll see investments in areas where we might look at how do we leverage the lunar infrastructure. There's frozen ice on the surface of the moon. Could we use that ice, that water, to turn it into rocket fuel or into oxygen? There's a lot of science that still needs to go on to understand the composition of that ice on the surface and how it could be used and what contaminants are on there.
Wow,
but
that's fascinating.
Yeah.
Lisa, I mean, we could talk about this for hours. We're heading into a commercial break, so we're gonna have to leave it there. But let's continue the conversation. I want to hear more. Lisa Callahan, Lockheed Martin Commercial Civil Space Vice President. Fascinating. We'll keep following your journey to the moon. Coming up, Instacart eyeing robots to replace in-store shoppers. We'll tell you all about it next. This is Bloomberg. Finally this hour, Instacart has a plan to replace its army of gig shoppers with robots. It is part of a long-term strategy to cut costs and involves building automated fulfillment centers across the country where hundreds of robots would fetch boxes of cereal and cans of soup. The story will continue to follow. That does it for this edition of Bloomberg Technology. Tomorrow we've got Electronic Arts CEO Andrew Wilson talking gaming.